So we get a global bust. The good news is that they have the printing press and they will respond so that it'll be a V where you go straight down and then you'll come back out because of all the money that's created. But then what gets created from that, with a lag of maybe 18 months, is a huge inflation cycle. So, everybody's worried about the 8 or 9% inflation we had this cycle and wanted to compare it to the early 80s and I was there, I was managing money when inflation, got to 20%. This will go beyond that. I'm predicting we'll probably see 25% inflation by the end of the decade. There will be parts of the market that will benefit from inflation. Commodities, it will be a commodity super cycle. Commodities will go through the roof. I'm predicting $500 oil by the end of the decade. Late this decade, early next. Predicting $20,000 gold, $20,000 gold. $500 silvers that are passively invested in S&P indexes or, any of the broad indexes are going to find that they're lagging by a long shot, that they can't keep up with inflation.
Hey guys, welcome back to Capital. And today I have the great pleasure of interviewing David Hunter for the first time ever on the show. David, thank you so much for making your maiden voyage.
Yeah. Hi, Danny. Thanks for having me on. Great to see you.
Yeah, it's our pleasure. David has been one of the few, I was just telling him off camera that he was one of the few who nailed the current market environment. I remember a couple years back, I was watching a number of your interviews, David, where you were calling for a melt up like we've seen over the last couple of years. And it's actually happened. So I'm interested to get your take on how you were able to kind of forecast that projection, and then also more importantly, where you see things going next. But before we get started with that, what I do as a customary thing on my show is whenever I have a first time guest, I'd like to get their origin story. So David, if you can, kind of run us through, how did you get to this point? How did you get interested in macro, the markets, the economy, everything like that?
Sure. Going all the way back, I started in the business in 1973. So I've been doing it for 51 years now. And back then, that was at least when I entered college, it was the height of the Vietnam War. And I declared as a finance major right out of high school. Just seemed it interested me. And I stuck with that. At that time, everybody was trying to get out of the draft, and a lot of people were liberal arts majors, what back then was affectionately known as hearts and flowers majors. But they didn't know what they wanted to do. They were just trying to avoid the draft. But I kind of decided finance early on and stuck with it. Got a job in a local bank out. I went to school in Indiana at Valparaiso University, got out of school and took a job right in town there with a small bank. I couldn't get to Wall Street from where I was. So I got into a small investment department, a two-man investment department, where, my boss was great at training me. And from there, I went to another bank. From there, ultimately started managing in-house money for Textron, was their equity manager. And that kind of took my career to the next level. I was top 1 percentile performer for 5 years running in the pension fund universe. And early on was a contrarian right from very early on. I think I'm a natural contrarian, so it came easily. And, I've stuck with that all the way through. Tend to zig when everybody else is zagging. I'm very comfortable being outside the crowd. So as a result, it's easy for me when everybody's in one place and I'm in a totally different place. Like I said, 2 years ago, that was the case. And I'm used to people doubting me, not understanding why I could have the position I have. It's, you do it for this long through many cycles, and it just kind of a very easy thing comes natural. And so anyway, I, have been a money manager for half my career, and the last half of my career has been a macro strategist, so I've been doing this a long time too. I was always a top-down manager. I, looked at the economy and the macro characteristics first before I, pick stocks. And so that again was an easy transition for me, moving over from being a money manager to a strategist. And with these markets the way they are now, there's even seems more and more the opportunity to be contrary. Now I don't go contrary just to be contrary. There are times in the market where I'm right along with the consensus. It's at the extremes of the extreme bottom and the extreme top that I'll be almost alone in my view. During the middle, I'll have people on Twitter say, you sound like everybody else. Aren't you worried that you're wrong now? And I go, no, consensus is actually quite right during the meat of the run. It's at the two extremes where the consensus can be very wrong.
Yeah, so let's dig into that for a bit. You made this call 2 years ago that we were going to have the melt up that we're seeing today. Number one, I like to kind of get to kind of understand how you're able to make that call. And then number two, what do you see now moving forward?
Yeah, certainly going back to October 2022, and I actually turned bullish, a few months before that. And actually, the internal bottom in the market occurred in June of 2022. People think, it was still, in a bear market then, but you look at housing, you look at some of the interest rate sectors, and they were starting to turn up at that point. We had a retest in October that broke the lows of June, but it was a very short break. It lasted for less than a day and turned. So I saw things technically I liked. Sentiment was all lined up. Everybody was looking for much lower. It was a very extreme bearish sentiment at that time. Those are the kind of ingredients that told me we were either at the bottom or very close. So I was willing, and I made the comment the day it turned, this looks like the reversal, the way it acted. So, and then along the way, as it rallied, what you saw was people early on were very skeptical and thought it would just be a few day rally and roll back over. And then when it carried on further, every time it lifted its head, you had people saying, well, the next level is just above here, and then it's going to go to new lows. So there was a wall of worry that stayed. The skepticism remained, surprisingly, for all the way up until I would say 4,300. We turned at 3,500, and about 4,300, you had some people starting to get on board, but they didn't see any chance of new highs. They thought maybe you could go a couple hundred points more. I called the pullback when it got to 4,600. I called the pullback back to 4,100. I didn't think it was going to go quite that low, but I called it down to 4,200, and said, well, we'll be going to new highs, substantial new highs. At that time, I had a 6,000 target, which seemed crazy. But again, up until we made new highs above 4,800, which had been the highs before the bear market in 2022, up until we broke that and moved above that significantly, most of the street remained pretty bearish, or at least skeptical of the market, and they were pretty defensively positioned. That continued to give me confidence that there was plenty of room to run. As long as you had that wall of worry, it wasn't a top. And that's still the case today. You've got, as I say, once we got above, say, 5,300, people got more bullish because the momentum was to the upside. But they were there without a lot of conviction. They were nervously there. They were only there because they couldn't afford to go against the momentum. So then when we get these sell-offs like we had in the beginning of August, you watch and you see that sentiment quickly flip. So you went from a level of, on say the fear greed gauge, a level of greed, all the way back to a pretty deep level of fear. It just flips around very quickly because people are really nervous about the valuations in the market. It's up there. I call this the last stage of a 42-year secular bull market. I can remember vividly because I was at Textron at that time, had just joined them 6 months before, and told them to keep their powder dry, that we were, in a bear market that would bottom that year. And it did. It bottomed in August of 82. And I can remember distinctly going to the investment committee, who was pretty cautious about equities. That's why I was brought in, was to kind of change that. But I was a 30-year-old kid telling these, 60-year-old CEO, the CEO of the company, chairman of the company, all their group VPs that were all, late 50s, early 60s, tell them I knew how to invest, conservatively in equities, and that they didn't have to be so nervous. And we started putting money back to work in August of 82, which was a turn into the new secular bull market. And it's been, 42 years since then that we've had these higher lows, higher highs. And I think we're in the last stage. I think we most likely top out this year. I've got a target of 7,000 now, and I think that may even be exceeded. So, the last stage will be the steepest stage, what I call parabolic final stage. But if we're at where we are today, on our 5,500 and change, or wherever we are, 5,600, if we're going to 7,000 and doing it this year, that's a hell of a ride from here. But that's what I think we're going to see.
Wow. Do you see the election results, whichever way they may sway, impacting where the markets might go?
Surprisingly, let me put it this way. There is a huge difference in the policies of the two, despite the Democratic candidate trying to co-opt some of Trump's policies and make it look like they're not that different. We know, anybody with the brain knows, Kamala Harris is very far left of center, and her policies are going to be very much like the Biden policies, if not more so. So she's obviously trying to win an election, so she's going to say what she has to say. But her policies are very different from Trump, who's more of a pro-capitalist policy approach. And so it really is, we really do have two very distinct choices. That being said, my forecast doesn't change an iota whether she gets elected or he gets elected, in terms of we're in the last stage, we're going to a top, and what follows that, in my opinion, is a global bust, which is something we haven't seen in the post-World War II era. What I say is 2008-9 on steroids. And I think that happens no matter who gets elected. So ironically, even though they're very distinctly different, and their policies are very different, ultimately my forecast is not dependent on who wins the election.
With some recent comments from Jerome Powell indicating that rate cuts are coming down the barrel here, do rate cuts? How do I want to phrase this? Will further quantitative easing from where we're at now, will that not save the stock market from this epic collapse? Let's say once it does hit that 9,000 price target that you've alluded to, because you've seen this throughout history, right? When like take the Weimar Republic for example, the stock market kept going up and up as the currency hyperinflated. Is that not also a possible scenario as probably quantitative easing comes back into play?
Probably not. Now, first of all, I want to correct you. It's not 9,000, it's 7,000. So,
sorry, 7,000.
I'm pretty extreme, but not quite that extreme. Although, like I said, it could exceed 7,000. So, but anyway, the reason I don't think so is we've heard from Powell for several years now say he does not want to go back to the policies of the past where we had zero rate policies and printed money like crazy. He does not want to be the owner of the Fed put. He does not want to support the market that way. So they're trying to be very deliberate about policy. He's been on record as saying he doesn't want to go back to QE. I think that's, we're not very far from that not happening. We are going to see QE. The problem is there are leads and lags to policy, and they're they're quite long. So he's looking at backward looking data. By the time he understands that he went too far, it's too late. And we've seen this every cycle with every Fed chairman and every FOMC committee. They leads and lags cause them problems, so they always stay the party too long on the tight side, create deeper recessions than they plan to, and then go the other way in a big way and create a boom. So we get these boom bust cycles. The problem now is that we have so much more leverage than we even had in 2008-9. I mean, 2008-9 we were very leveraged, but we're talking about massive leverage beyond anything this world has ever seen before. So that when things turn down, and if the Fed, in my opinion, Fed's over tightened, they've stayed too long on the tight side. Their rates right now are so far above the inflation rate and above even the market rates, 2-year rates. We're the tightest we've been in this whole cycle, even though, they're talking about, starting to cut rates. So that means, and it's not going to necessarily be clear to them now, but in the next 6 months, you're going to see, I think, or 6-9 months, that the economy's a lot worse off than we thought. So by the time they recognize that they've got to get aggressive on the easy side, things are already happening on the downside in a big way, similar to 2008-9. And because of the massive leverage, and I define leverage as both the debt we have in the world, which is, massive, and then on top of that, the derivatives, which we have, notional value of trillions, quadrillions. The derivatives are leverage on the markets, and obviously debt is leverage on the system, on the economy. What leverage does, it enhances on the way up, and it really exacerbates the downside. And it exacerbates it in two ways. If you're rolling over, it'll roll over much faster with leverage, and it will also be of a magnitude much bigger than would happen without a lot of leverage. So it's the leverage in the system that can cause me to forecast a global bust. And I define a bust as something bigger than a recession, looks like a depression, feels like a depression, but happens at the speed of a recession. So, I think most of it will be contained next year. It'll be massive bank failures around the world. We'll have them here, but not like 2008-9, because our banks are in better shape today. They're not as leveraged as they were then, but Europe's in worse shape. Their banks are in worse shape. Canada, Australia, Asia, there's a lot of risk out there, and it will domino across the world. What's happening here is happening around the world. The central banks are overly, they're trying to fight the war of inflation that's behind them, and not understanding the risk of deflation that's right ahead of them. So that's a long way of saying I think the Fed is going to be slow to respond. They don't want to do QE, so they're going to drag their feet. And by dragging their feet, with leverage in the system like it is, they'll come in too late. We'll already see the damage. Then they'll react to the damage. And you will see, in my opinion, something like 20 trillion in balance sheet expansion for the Fed, and similar around the world proportionally, not the same numbers, but proportionally. So we did 5 trillion in response to the pandemic, right, back in 2020. I'm talking about 4 times that number, and that number was way off the rails. We had never done anything like that before. So I'm talking about numbers that are mind-boggling. I mean, $20 trillion in new money, but that's what I think is going to take, along with the other central banks, to stop a free falling financial system. So we got a taste of it in 2008-9, right? We saw what, our banks were basically down to zero, Citibank, et cetera. We got a taste of how close we came, but they pulled us back from the edge because we've learned the lesson we learned, which is, we shouldn't be doing all the, what we did the last decade of all this money printing and all this 0% policy, because that's the lesson they learned. They're going to be slow to react, and that extra time it takes to react, combined with that leverage in the system, combined with the fragility that's been built in because of the pandemic. There's still a lot of problems under the surface. When you add those three things together, I think we crater. I mean, we almost saw it in 2008-9. We had GE almost fail. The commercial paper market was frozen, and they reacted just in time to save the system. This time, I think because of what's playing in everybody's mind about how bad that was, what they did the last decade, that extra pause, that extra reluctance to do what they need to do is going to push us over the edge. So we get a global bust. The good news is that they have the printing press and they will respond, so that it'll be a V where you go straight down and then you'll come back out because of all the money that's created. But then what gets created from that, with a lag of maybe 18 months, is a huge inflation cycle. Mm. So, everybody's worried about the 8 or 9% inflation we had this cycle and wanted to compare it to the early 80s and I was there, I was managing money, when inflation, got to 20%. This will go beyond that. I'm predicting we'll probably see 25% inflation by the end of the decade in the U.S.
Wow. So, is that year over year or what?
Yeah, I think you could see it year over year, but not sure if we'll get quite that far year over year, but you'll see 25% at least for a matter of months. And if we get 25% inflation or anything close to 20% inflation, you're going to have treasury bill rates up near that same 20% anyway, and long bond could be, between 15 and 20%. When you've got the kind of debt servicing requirements we have today, and then keep in mind, I'm talking about 20 trillion new money. That 20 trillion new money will be pretty much matched by new fiscal, meaning another 20 trillion in debt, new debt. So, we're talking about 35 trillion in just U.S. government debt right now. That could grow to, over 50. We can't service it at 5%. How are we going to service it at 15% or 20%? So it's a dire story down the road. But in the meantime, you're going to have first the bust, first the market running to this top, the parabolic run up, then a bust, and I think an 80% bear market peak to trough. Then from there, you'll have a cyclical bull market because of all the money created. So you can, out of the bottom, if let's just use my number on the S&P of 7,000. If we just for an example, if we do hit 7,000 and have an 80% bear market, that takes you down to 1,400. You could have a triple or quadruple out of the bottom because of all that money created. So a new cyclical bull market, but even that only takes you back, say, to 5,000 or 5,500, as opposed to 7,000 or whatever. So you're not going to see those highs again, in my opinion, that we reach later this year. I don't think we'll see those for decades, because you'll have a cyclical bull market because you're going to have all this money. You can have rates going to, down near zero initially and moving up gradually initially. But then inflation takes over and rates start moving up much more aggressively. And when rates move up, PE multiples move down. It's an inverse relationship. So we had this secular bull market for the last 42 years, in large part because PE multiples went from single digits back in 1982 to 20 or 25 times market multiple now, or at the top, and we'll see the we'll see the reverse of that in the second half of this decade, where market multiple will be getting squeezed and going lower as rates move up, and so that's going to keep the indexes from being able to move ahead. They'll, like I said, they'll have a couple of years, or at least a year or two, where you still have rates relatively low, you still have inflation relatively low, and you have a lot of money being put to work. But then by say later 2026 and then beyond, your rates are going to be moving up more aggressively, and that's going to squeeze multiples. There will be parts of the market that will benefit from inflation. Commodities, it will be a commodity super cycle. Commodities will go through the roof. I'm predicting $500 oil by the end of the decade. Late this decade, early next. Predicting $20,000 gold, $20,000 gold, $500 silver, copper. Who knows? Could go to $20 or more. From I'm predicting $6 pre-bust. So this year, and then could go down as low as $1 in the bust, and go from there to 20 or 25 in the big move, big commodity cycle. Natural gas will go through the roof, et cetera. So I think all commodities, including ag commodities, will be huge winners post bust because of all that money. What happens is you're going to create all this demand across the board because you've printed all this money, and commodities don't have the infrastructure. We've been rationalizing down our commodity capacity for decades. So all of a sudden you blow up demand. You can't create supply that quickly. Supply, you have to create new mines. You have to, create new refineries, et cetera. You're just not going to be able to meet the demand. And the only thing that can give when demand far outstrips supply is price, and price will go through the roof. So that sector of the market will do well. Commodity producers will do well. But those that are passively invested in S&P indexes or any of the broad indexes are going to find that they're lagging by a long shot, that they can't keep up with inflation because their indexes are either going down or not going up anyway.
Are you in the market for gold and silver? Then if so, please consider Miles Franklin. They are my gold and silver dealer of choice. So not only do they have super competitive prices that you're going to have a really hard time finding elsewhere, but then they also have top-notch customer support. I know Andy Schechtman, the owner of Miles Franklin, top-notch guy. I wouldn't be recommending them to you if I didn't have faith in their product. But what you really want to do, however, you want to email them at info@milesfranklin.com, and you want to say that Capital Cosmos sent me in the description line, because when you do that, you can get access to their special pricing sheet. You want to get that special pricing sheet because you're going to get special prices that you won't find on the website itself. So email them at info@milesfranklin.com. Tell them that Capital Cosmos sent you, and you won't be heckled with spam emails, etc. There's no commitment necessary. I promise you that. And with that said, I will let you get back to the video. Yeah, so when we do see this global bust, typically how it goes is that you have all these margin calls and everything comes down, right? Including the likes of commodities and gold, which has been a rock star this year. But if we do see an 80, let's just say an 80% crash in the S&P, do you see commodities falling in tandem, but at a lesser level or not as bad as the broad market will, or no?
Yeah, a lot of the cyclical commodities are going to fall just as hard as the equity market. Copper, like I said, copper could go from 6 to 1. Natural gas will go back towards $1 or below, probably. Oil, I'm predicting $30 oil in the bust next year. Gold, I think I'm forecasting gold to 3,000, and I think I'm going to raise my target on that pretty soon. And I'm forecasting $75 silver. Those are pre-bust targets, so So that means sometime between now and first quarter next year, they don't have to top out right when the market tops out. They could extend for a few months, but I'm predicting pretty good runs here in metals. From there, if silver goes to 75, it's a more cyclically based commodity, right? Than gold. So silver might fall all the way back to here. It could fall 2/3 of, give up 2/3 of it. I don't know. Might be 50%, might be 2/3, but it could fall, back, certainly back to here, maybe even below here. Gold, on the other hand, has other, it has some flight to safety characteristics to it and things. So gold might, if it, let's say I raise my target. Well, let's just use 3,000, which is my target now. If it's 3,000, it might fall back to where it broke out at 2,100, something like that. If we go beyond 3,000 to 34 or 500, it might only fall back to 2,500, something like that. So it'll fall and fall pretty hard, but not nearly as much as the equity market, I think, is the case. Whereas the real commodities, I think, can get hit very hard because a global bust means demand's going to be falling through the floor.
Yeah. I mean, you kind of saw a preview of this a few weeks back with the yen carry trade unwind. Markets fell pretty badly for a short amount of time, but gold and silver actually held up fairly, more so gold, right? Gold really kind of held up around the 2,400 handle, whereas everything else fell a lot steeper. So, it may be the the clean is sure and the dirty hamper, which is something that's often attributed to the dollar. But what about real estate? Where do you see real estate going over the next several years as well?
Yeah, good question. I don't talk real estate that much because it's not my expertise, but from a macro standpoint, I think we've seen the high water mark in housing prices. Obviously it's regional, so every place is different, but generally, I think across the country, housing peaked a year ago, probably. And I think that was a high water mark. You're getting some bounce now, I think, as rates come down. So, but I don't think we're going back to those highs of last year in most places. There'll be exceptions, but and then in the bust, I think you're going to see a 30% plus decline in home prices from here, or probably from the peaks at least, but maybe even from here. So 30 to 40% decline would not surprise me. That probably only gets you back to pre-pandemic levels, but and it could be bigger. Certainly, some areas, Florida and Texas are already rolling over and have excess inventories. So some places will probably be hit harder than that even. And what I caution people is people think real estate is an inflation hedge, so they assume that the second half of this decade, with my inflation forecast, that housing will be going up in price. I said, keep in mind, if we have 15% 15 to 20% 10-year rate, the mortgage priced off of that, the mortgage rate's going to be 15 to 20% probably or higher. So you're not going to see home prices move up when, for most people, those with cash are a different story. For most people that have to finance a home, that mortgage payment is what determines what they can afford. And monthly mortgage payments are going to go through the roof if we get those kind of rate moves. So I think that really caps real estate for the next cycle and probably puts downward pressure on it. So you get hit hard in the bust. You might get a couple of years where rates are still still behaving. And but the problem is, in the bust, so many people are going to be hit by their, the wealth factor. They may have lost their job because we may even see double-digit unemployment. They have seen their stock portfolios go sharply lower. So, consumers are not going to be in a great position in, say, 2026 when rates are on the floor. I think next year, the 10-year can go to zero. So when I say the floor, I think we're going to see, we could see for the real prime borrower, we could see a 2% mortgage rate, 30-year fixed mortgage rate next year. But most people won't be able to get that rate because banks are going to be very stingy, and it'll be only the ones that can really show pristine credit that will get that. But even those that have less than pristine, the rate's probably going to be down below 3%. So, but the problem is people are going to be in no mood to buy houses next year, and maybe in no shape to buy houses. So then you might get a bounce in 2026 or even into 27. But I think by 28, 29, 30, mortgage rates will be double digit and moving higher. And I just think that's going to very much limit the housing market. So I think the last many decades of housing always going higher, I think that game's over.
Yeah. Let's go back to the carry trade for a second. Is the yen carry trade unwind? Is that over? Is that over and done with, or is there more to the story?
Yeah, well, I'm sure there's some people that didn't overreact, and that there was more to be done. But I have a feeling they've had the yen backed off, and I have a feeling some of those that didn't panic on August 5th probably have unwound their trade. And they've certainly had the opportunity in the last couple of weeks to do it in a more orderly fashion. So I think anybody that really was worried about the yen carry and the fact that the yen is probably done going down, I think those people had plenty of chances to unwind. So I don't think that's going to be a factor here in the next few months.
What about the prospect of a powder keg blowing up in the Middle East or in Eastern Europe? How would that factor? Number one, are you factoring that into your analysis? And if so, how does that factor in? Like,
yeah, there's always the wild cards out there that can happen. It's very very hard, if not impossible, for a macro strategist to factor that in. I will only say that my own tendency is to say I think that stuff is probably not, the worst case things are not going to happen. I don't think we're going to see a full out Middle East war. I think Iran knows, and I think you saw basically when we sent carriers into the region and basically made it clear that we will defend Israel if you attack. Iran pretty much, I think, was rational and said, "Hey, we're gonna continue to cause problems, but we're not going to go all out and invite, a massacre." So I think cooler heads prevailed there. Doesn't mean they're not going to continue to cause problems, and it doesn't mean they couldn't have a surprise attack when now that things are settling down a little bit, or when Israel's not looking, etc. But I just don't see an all-out Middle East war. Taiwan's always a wild card. I don't think China's, people want to throw that out there every time and predict it's coming in 6 months or whatever. I don't have any information that anybody else doesn't have, but I would tend to think it's not in China's best interest right now to stir that up. What's going to happen over the next the balance of this decade? That's anybody's guess. You certainly could have something that comes in and changes what I'm calling for. But I think in the next year, I'm pretty comfortable saying it's not about geopolitics. It's about the macro.
Gotcha. What concerns you the most, David? What's front and center for you right now?
Well, if you knew my full forecast, which is that we are, once you follow through on this, bust and then commodity super cycle and hyperinflation, I was kind of getting at it when I said I don't know how you can't solve the equation of servicing our debt, and not just our debt, but around the world. This is all going to be happening around the world. There's no way these governments are going to be able to service their debt. I think we get a collapse of the global financial system in the 2030s. So that worries me the most. I tell people, It's out there. Maybe when I say 2030s, people want to say, "Oh, in 2030." I said I didn't say 2030. I think it's probably 2033, 4, or 5, somewhere out in the middle of the decade. But that's still a decade away. I tell people don't lose sleep over it because there's a lot going to happen this decade that you can, get your house in order this decade because there'll be opportunities to make money in commodities, even if it's not in the index funds. There'll be opportunities to protect your capital before the bust. There's things that you can do to prepare yourself for what's coming a decade out, or at least better prepare yourself. But sure, what my forecast is very dire. As much as I'm on Twitter and getting, I got attacked for a long time on my melt up call. Now that it's happening, we're jumping on the bandwagon. But, as much as that sounds great, it's the last hurrah before a lot of trouble sets in. So, the bust is going to be no picnic. I think it's the biggest downturn we've had, both market wise and economically and financially in the post World War II era. So that's not small. That's huge. 2008-9 was no picnic, and this is bigger, in my opinion. So there's plenty there to be concerned about, and there's plenty to at least know how to invest beyond there. But then the 2030s, I don't know how. It's a very dire period, as I have said on a couple of my interviews. The scenario I paint in the 2030s potentially is that you could have 50% plus unemployment in this country with a government that has broken down so that there's no unemployment benefits, no welfare system, limited or no Medicare and Medicaid and Social Security. That's you can't get more dire than that. What comes out of that, I have no idea. It could be totalitarian, it could be something else, but that would be the thing that worries me most. But it's far enough out that it doesn't keep me up at night. In terms of near term, people are always asking what can go wrong in your forecast, and of course, things can go wrong. I can have a wrong macro forecast, but ultimately, this is a high conviction forecast. As crazy as it is, as extreme as it is, based on my 51 years doing this, and I think I do macro as well as anybody. This is a high conviction forecast, and it shouldn't be given how extreme it is.
Yeah, you've definitely given us a lot to chew on, David. And we've covered quite a bit. Is there anything else you want to cover before we wrap things up?
I will just say that I think next year, the treasuries are going to be the one thing that will hold up in the market. We didn't talk about the dollar, but I'm calling for the dollar down, DXY down to 80 in the next 6 or 8 months. And then during the latter half of the bust, I think the dollar becomes the flight safety trade, and you could see it go all the way back to 120 or higher. But I think that's the last hurrah for the dollar, because I think the story beyond that, with all the money created, et cetera, you could see a dollar down to 50 by the end of the decade. So, but I think the dollar short term is going down, and then will be something that will hold up once you get down to 80 in the bust. But treasuries, on the other hand, I think you could see 2.5% this year in the 10-year, and I think you could see 0 at the bottom of the bust, because they're going to be buying up every treasury bond when they do QE, right? So there'll be plenty of demand from the Fed as well as other places, and I think short rates will probably go negative during the bust. So treasuries will be one of the places you can hide, I think, during the bust. There won't be very many other places. I don't worry about FDIC insured savings. I think they will provide, because of the printing press, they can provide whatever money is needed for the FDIC to meet liabilities. So I think as long as you're within the $250,000 threshold, I think your savings will be safe. And frankly, last cycle in 2008-9, we had the don't break the buck policy with money markets. So they basically backstopped the money markets. my guess is when they're printing money, they're going to do whatever they can to backstop money markets and bail out pension funds and things, but they're not givens. Those are, I can speculate on that, but those at this point are not givens. Treasuries are pretty much a given because it's government guaranteed. It's not implicit; it's stated. So I just want people to know there are going to be places to hide. Not very many though, and you really, if you don't protect your capital and you lose it, there's going to be, you're going to have a harder time getting prepared for the 2030s. So I think it's important to don't get crazy, and it's going to, as I've said, people are still pretty skeptical about this market. At the top, I can predict, given my years of watching sentiment, at the top, you're going to have everybody all in. There's going to be a compelling story that the Fed's aggressively easing and that there's a long cycle ahead. I don't think there is. Obviously, I'm calling for a bust next year, but that's going to be the narrative at the top. And you've got to resist that if you're going to avoid, the trap, because obviously that's how sentiment works. At the top, everybody's all in. At the bottom, nobody wants it. So you've got to reverse that. That's what contrarian means, is you've got to be able to fight the crowd.
Yeah, definitely. I mean, it comes with the territory, right? I mean, you saw you get the most flack when you're over the target. So, David, I've got to thank you again for coming on. This has been a splendid interview. Where can people find you?
Yeah, I'm on Twitter pretty much every day. I have to say to people, I get every once in a while I'll get somebody saying, "Gee, I haven't seen you. Finally, are back. I haven't seen you in a long time." And it's because I don't do a lot of original tweets. I used to originate more tweets, and then I'd get bombarded with so many responses, and I was trying to keep up with them. So I reply to people constantly. I'm on Twitter every day. My replies, I can have many dozen replies a day. So when people are not seeing me on Twitter, it's because their settings are only set for, original tweets. They need to get the settings right to be able to see that I'm there every day. Good market or bad, when the market disagrees with my forecast, I'm still there. People start accusing me of being wrong the minute the market rolls over. But I'm there every day. So my handle is at Dave H Contrarian. That's not David, but Dave, at Dave H Contrarian. Be careful. There are, and I am verified or whatever by Twitter. I never sought that out, but they changed their policy many months ago. So I do have the blue check. There are lots of fake accounts out there that will change a letter in my handle, change the spelling of contrarian or what have you. So you just have to be aware. I have over 205,000 followers. The fake accounts might have hundreds or 1,000 followers. So I only have one account, and that's the way to check it. And then I also have an investment letter that I put out quarterly. It started out as, I've been writing it since 2000. So it was an institutional letter. When I was on Twitter and started doing this a few years ago, I started opening up to retail. I get good feedback. People say it's very readable and understandable. And I don't tend to speak in terms that people don't understand. So I do have a lot of retail clients now. And that is, the easiest way to find out about it is by subscription, meaning there's a cost to it, is to direct message me on Twitter and I'll provide details.
Yeah, we'll have the links to all of those down below. So be sure to check them out, guys. And before we sign off, I'd like to ask you to hit that like button if you enjoyed this video, to comment down below. Go, Dave, go. If you agreed with Dave's analysis, if you disagreed, let me know. Really interested to get your take. And then also, last but not least, don't forget to hit that subscribe button if you're enjoying these videos. We're posting just about daily now. So hit that subscribe button and that bell notification so you don't miss an episode. And with that said, I'll catch you in the next episode. Bye, guys.
Thanks, Danny.